Everyone, it's Zach back with a new mortgage video. Hope you're all having a happy Monday. If this is your first time seeing one of my videos, welcome to my channel. If you're a returning viewer, welcome back, where I'll try to demystify all things mortgage related. If you find this content helpful, please like and subscribe to my channel. So today I wanted to do a market update talking about Friday's report, which I had previewed on Thursday, and talk a little bit about what's on the forecast and how that could impact mortgage rates. Friday, we had the big day of jobs data. So we had unemployment rate, which came in as expected at 4.2%, which was a little higher than I expected. And non-farm payrolls came in above expectations at 227,000, which was also higher than I expected. Now, it wasn't dramatically above expectations, non-farm payrolls. So both of those kind of came in around expectations. So as I said in my last video, I felt like unless it was really bad data for the sake of mortgage rates, meaning really low unemployment and really high non-farm payrolls, anything other than that would lead to better mortgage rates and movement towards a consensus of a 25-point rate cut, and that's what we saw. So now we are at 86% likelihood of a rate cut at the Fed meeting on the 18th, whereas we were in like the 60s before this report came out. Big question is, was this deserved? And I'm not so sure it was. Again, these reports came in kind of as expected, but if anything, a little hotter than expected, showing a stronger job market, and yet mortgage rates have gotten better. Usually it goes the opposite way. The big thing that is going to be important, this Fed meeting on the 18th, the Fed will be releasing their dot plot, which is their projections of what's going to happen with the economy, with inflation, unemployment moving forward. Back in September, that projected things toward the end of this year. So this upcoming meeting, you get side-by-side comparison of where the economy actually is and where the Fed thinks it's going to be. The Fed does these dot plots every quarter, but it's only at the very end of the year when you can see exactly where the numbers are now, because they're doing year projections. They're not doing quarterly projections in these dot plots. So where the Fed expected things to be was a 2.6 core PCE inflation number, 2.3 overall. Right now, that is, the 2.3 is accurate, but the core, which is actually what the Fed cares more about because it strips out some of the most volatile elements of inflation that the Fed doesn't feel they can control as much, that number is above the Fed's expectations at 2.8%. The Fed, in their last dot plot, said that the unemployment rate they expected to be at 4.4%. So even though it has ticked up to 4.2, it's still below that expectation. GDP, Fed expected that to be at 2%, and it's been higher than that. They'll do revisions, so it kind of changes, but it has certainly been above their expectations. So all of that paints a stronger economy than the Fed was expecting, which is a good thing in general, but when it comes to mortgage rates, not so good, because strong economy can lead to inflation. So at the last Fed meeting, in their dot plot, the Fed expected 4 rate cuts, or a total of 100 points in rate cuts by the end of the year. Now, at that meeting, they did their first cut, which was 50 basis points. So basically, they're saying we're going to get another 50 basis points. But what's important is that it was a very close call between whether it would be 100 and 75. I think it was one vote that swung it to the consensus of 100 versus 75. So they were very much on the fence of how much they're expecting. We've gotten another quarter point rate cut. So we've had a total of 75 points in cuts since the Fed made this dot plot. So hotter than expected economy, to me, suggests it tips in the favor of just doing 75, because that was so close and the numbers show a hotter economy than the Fed was expecting back then. So all that to say, I'm not as confident as the market is that we are going to get a 1/4 point rate cut on the 18th. Now, what could change that? We've got consumer price index inflation coming this Wednesday. Now, while the Fed prefers PCE, CPI, about 70% predicts PCE. So it is the biggest market mover because it comes first. PCE always comes at the end of the month. So if CPI comes in a lot better than expected and predicts that maybe the PCE number will be coming down, especially that core number to where the Fed expects it, then maybe I could see a 1/4 point rate cut. Anything other than that, and especially a hotter than expected CPI number, I would be very concerned that we're going to get a rate pause. And the problem is when the market is this sure of an outcome, not having that outcome is likely to be negative, very negative for mortgage rates. Now, that said, think back to September. September was when we got the first rate cut, and the market leading literally minutes before the rate announcement, the market was split 50-50 on whether it'd be a 50-point or 25-point cut. We got a 50-point cut, and that didn't really move the needle much because the Fed released their dot plot, showing their future expectations was much more conservative than expected. So suffice to say, if we do get a rate pause, but we get the opposite of that, meaning a dot plot that is more aggressive, let's say they're expecting 150 points in cuts in 2025, that might actually be good for mortgage rates, or if nothing else, it probably would mitigate the negative of the rate pause. But if, on the other extreme, if we get a rate pause and let's say the Fed says they're only going to cut 75 basis points or 50, especially in 2025, that would be brutal for mortgage rates. By no means am I saying that we are definitely going to get a rate pause. I'm just much closer to 50-50 than the market appears to be. But if you have any questions or comments, feel free to shoot them below or call, text, or email me. But thanks for tuning into this market update, and I will see you next time.